Hey, good morning, everyone. Marty Missouri here, Thursday, the 21st of March, 2024, with an end-of-week market snapshot for you. Clients, this will come attached to an email tomorrow morning as Friday's message. Want to, of course, talk about yesterday's event at the Federal Reserve, what the message was, what the implications are. Want to ponder what may have been behind frankly, the surprise message. And then we'll get to just a quick look at some charts on the usual suspects that we've been featuring here now for weeks and weeks. So I wanted to start with this morning's written blog, which I titled Come Hell or High Prices, and a look at gold and stocks. It's rare that they hit all-time highs at the same time, and I'll offer up some history of that phenomenon. So first of all, stocks, which we've explored, are historically high from a valuation standpoint. They were jittery. They were down a couple weeks in a row heading into the rate decision yesterday and the press conference. And I would say they were jittery for good reasons. You can see that gas prices year to date are ramping up. Oil price is way up on a year-to-date basis. Food prices are scary high on a year-to-date basis in terms of the trajectory. And copper, as we've talked about on the weekly economic updates, has caught quite the bid so far this year. And I showed you last week the shipping costs via the Baltic Dry Index and that sort of thing. So underlying inflation pressures have heated up. And that arguably is why the market was fearful of what Chairman Powell might say yesterday. It wasn't that long ago when their primary concern was a policy mistake that would be essentially cutting too early. They made no bones about it, that they did not want to see a repeat of, for example, the early 80s, where the Fed hiked interest rates, the economy began to roll over, inflation started coming down, they panicked because of the recession fear, cut interest rates aggressively, only to have inflation come roaring back, had to tighten all over again in a very short order, and then ultimately creating a much worse recession than the one that they were trying to avoid. So we had two back-to-back recessions, the result of a policy mistake by the Fed. So here the market is seeing inflation come back, forward inflation indicators have bottomed and beginning to turn up. So it made sense that Chairman Powell would talk back the prospects for rate cuts this year, and that the dot plot, which is where they each anonymously put a dot on a chart that says where they think rates are going, would actually show fewer cuts. Well, that didn't happen. The dot plot shows kind of a concentration around 3 cuts this year. That right now is what the market anticipates. And Chairman Powell basically all but promised that we will get rate cuts this year, come hell or high prices, as I titled this morning's blog. So what on earth could that mean? Some will say that it's politics, and I think there's a legitimate argument there. And if it is politics, but they want to avoid looking political, well, they need to get started sooner than later. I'd say June is about as late as they would want to go. So I think he really left that door open for a June rate cut, maybe even a May rate cut. Now, if inflation continues to come roaring back, or starts roaring back, let's say, that's going to be problematic because people are going to be very, very upset about inflation. They'll love the markets if the Fed continue to talk the market up. And there does seem to be a correlation between consumer sentiment and the U.S. stock market. But the inflation is a real problem. That's something that people haven't had to deal with, comment on in surveys, yada, yada, for, several decades. And then the other, maybe as plausible, if not more plausible scenario, is that the Federal Reserve sees what we've been showing you here week after week, and that is indications that a recession is a not small possibility late this year or into the first half of next year. And they have a few hundred highly qualified economists working for them. And that may be the underlying signal that they're getting. And that's still essentially our base case, is that yes, this inflation and this pickup in the economy likely is a head fake, that things will indeed roll back over, inflation will come down, and the economy will slow. And if the Fed is anticipating that, then I think they can be a little bit sanguine. If not largely sanguine, I would say that was Chairman Powell's essential message in the face of some inflation that's coming back. Now, if you listen to folks like Vincent Deluard with StoneX, who is frankly one of my favorite analysts, he does not necessarily see a recession. And he thinks, for a variety of legitimate reasons, that inflation is a serious problem that's not going to go away over the next few months. Now, if he's right, we've got an altogether different problem, because the Fed's going to cut into a higher inflation environment and ultimately is going to have to reverse course. And that's not going to be good news for the markets either. So on one end, you have these recessionary forces, the Fed juicing markets, juicing animal spirits in hopes of circumventing a recession that is showing up in many of the indicators. If that is their stance, and it still is ours, if that's correct, well, then the recession is going to bring corporate earnings down, and that's going to be truly a mess for equities sometime over the next, say, 3, 6 to 12 months. But if folks like Vincent Deluard are correct, and the economy isn't rolling over, and inflation is going to come roaring back, that's also, I believe, the thesis of a very popular macro analyst, Jim Bianco, as well. Two people I have an immense degree of respect for, just don't necessarily agree right now, but because we have such respect for them and they are so smart, we have to really explore their thesis and give it ample consideration. But without rambling any further, it makes a lot of sense to me that the Fed is actually listening to their economists who say, you know, this economy is not out of the woods and it's going to need some help. And if we get in front of that, perhaps we can circumvent it. The problem with just throwing the kitchen sink at it, of course, is that we are now in what we believe full-on, long-term, is a structurally higher inflation regime. It's going to be tough to stimulate into that without creating inflation. Nevertheless, they absolutely will, particularly in a recession scenario. I read an article yesterday where several states are experimenting with guaranteed basic income for people. And it's something that's being broached at the federal level as well. And folks, that's just part and parcel to the new labor-friendly regime populism that we're now in. That is inflationary. And we've looked at the history of that in detail here in client meetings and on the blog, and I'm sure we'll do more of that as the weeks and months unfold going forward. And I guess you could argue, if it's not that the Fed is worried about recession coming, it's that they are resigning to the fact that inflation is going to run hotter, because no longer do they have to see that 2% inflation to begin cutting rates. They basically promised it as long as inflation just isn't going to the moon. So, folks, lots to work through there, lots of mixed messages, of course, and lots for us to think about, to exploit, and to protect against, again, in the coming weeks and months. Here I show the big pop in the S&P, and it's continuing. Pretty nice rally even today. Certainly not across the world, not across commodities like yesterday. Gold's actually off a little bit today, but you can see it went to the moon yesterday as well. Analyst with Bloomberg, Tatiana Derry, talks about that it's rare for stocks and gold prices to be near, at the time she wrote this article a day earlier, record highs simultaneously. Now is one such moment, and it's not a good sign for equities. Now, of course, they can go in the same direction at times, but it's very rare for them to push toward new peaks in unison. In fact, since we completely left the gold standard in the 1970s, it's only happened a few times during the inflationary spiral of the early 80s, right up to the great financial crisis, and in 2020, and she kind of discounts 2020 because of all the huge stimulus, and basically every crack on the planet had to get filled, including gold. So she basically takes that out and says, you know, we really need to focus on the rampant inflation scenario in the 80s and right before the greatest financial crisis since the Great Depression. And the basic case is that gold does well in anticipation of potentially severe financial hardship or a very, very weak economy. Of course, gold can rise with inflation and a weak dollar, but also it's a safe haven in a terrible storm as well. So I think what she's speculating here is that perhaps gold is anticipating something quite ugly, and stocks are blind to that possibility. I might argue, particularly with regard to yesterday's action, that this goes back to our thesis or our agreement with the thesis that when you're at 130% debt to GDP, ultimately the Federal Reserve is going to have to play a 1940s act, and that is where they somehow cap the interest rate, keep it relatively low, and let inflation run hotter, essentially inflate the economy at a faster pace than the national debt, and get out of this really messy ratio that's north of 130% currently. So what that equates to is negative real interest rates. That is an utterly beautiful setup for gold. And when you listen to Powell yesterday, just really kind of poo-pooing the inflation risk and saying we're going to cut interest rates, that's kind of that combination that I'm talking about. The other thing, too, is that apparently there's been significant purchasing of gold by central banks. Remember, the U.S. froze Russia's dollar reserves, and that essentially got the attention of probably all foreign central banks. And the one thing that would be good in all currencies, and is essentially a currency itself, is gold. So there has been a lot of purchasing of gold by central banks, and many speculate that has been a not small factor in this move for gold to record levels. I think yesterday, though, was more about gold doing well in a negative real rate environment, yada yada. But lots to parse there, but we do like gold long term. We think short term it's subject to a downturn. I showed you the technicals here recently, and sure enough, it did come off of that level before yesterday when it came roaring right back. So folks, a lot there to think about. One more thing before I get into the charts, and we'll just do the charts super quick. A couple of quotes I copied yesterday. Bob Elliott, he runs money now. He used to be with Bridgewater, the largest hedge fund on the planet. The majority of the Fed board members project that through the end of 2025, growth will remain above potential, unemployment remains at secular lows, core personal consumption's expenditure inflation remains above mandate, above 2% for the fifth year, and the Fed cuts by 175 basis points or more by the end of 2025. One of these things is not like the others. I chuckled when I read that, and he, frankly, is spot on. You have all of these, right? And it just makes zero sense that all that occurs, and they still cut interest rates by 175 basis points. There's something behind them sending that message that has them concerned, whether it's, as I said, politics, as some believe, or whether it's, under the surface, a far weaker economy than some of the headline data indicate. We'll find out, certainly, before the end of 2025. Oliver Rennick with Schwab. This is yesterday. It's days like these in which the Fed calls 8 months of reflation data noise that Bitcoiners look like they have the right narrative. I'm surprised that it's not going ballistic. It's up like 4 or 5% this morning, by the way. Only other reason for FOMC messaging would be that they fear slowdown, and that's what I just spent several minutes talking about. That very well could be, folks. Okay, so having spent so much time, we'll just take a look at charts that essentially look the same, and I think I'll just touch on the equities and let you go. So the S&P really tried to break that uptrend line, and no doubt would have if the Fed did, as I think the market worried about. But obviously, as we just explored, they did not. And now we're pushing right back up to the top end of this wedge pattern. We do have these long and threatening bearish divergences. We do have a new buy signal there. but we do have momentum that is not confirming the upward move. And same thing on the RSI, and we're about to get right back into overbought territory. Would make sense to see a day or two of weakness over the coming week or so, if not more, ultimately. As for the NASDAQ 100 index, and we'll just do the daily charts today, yeah, it was ready to go. I think it was anticipation that the Fed was going to be hawkish based on all the inflation data. Broke down below that 20-day moving average. You can see when it's done that with force in the past, it's meant something meaningful. Well, recaptured that again on the Fed. You can thank them completely. Gapped up some this morning, testing the bottom of the uptrend line right here. This would still be an objective short if the market is going to come back and test that. The way the technicals look with these bearish divergences is that it would hit that and roll back over. But we, of course, remain open to all possibilities, particularly when the Federal Reserve seems to be really committed to being accommodative this year. It's an election year. One thing they do come with typically is a good amount of volatility. If recessionary forces take hold, the macro dynamics would suggest that we get that last leg down in the bear market. So lots of scenarios. I think volatility is a given. And folks, I'm just going to stop there. This is going a lot longer than anticipated. And I'll be back shortly with your weekly economic update. Have a great rest of the day. Take care. Bye-bye.